All right, let's dive right into this explainer and totally demystify how initial public offerings actually work for everyday retail investors. If you've been following the financial news lately, you've probably seen the headlines, right? They're always screaming about massive first-day gains, wildly oversubscribed share allotments, and just the sheer undeniable hype surrounding new companies hitting the stock market. But beneath all that noise and excitement, there's actually a very structured mechanical process. Today, we're going to break down that exact process, step by step, so you can approach your next investment with total clarity and confidence. We've got a lot of ground to cover today. We'll start with what an IPO actually is, look at how companies go public, walk through the application process, figure out how to evaluate all that hype, and finally, discuss the strategy of buying on day one versus waiting. Let's get started.
Section 1. What is an IPO?
So to start playing the game, we first have to know exactly what the game is, right? Think of an IPO as a company's grand opening to the public. For its entire existence up to this point, the company has been privately held. That means it's been owned by its founders, maybe some early employees, and probably a few venture capitalists. But to fund some major expansion, they need a lot more capital. The IPO is the mechanism that transforms that private enterprise into a publicly traded one. The company issues shares, and in exchange for your hard-earned money, they invite you to become a partial owner, a shareholder for the very first time. And crucially, the company doesn't ever have to repay the money you used to buy these shares. Instead, you take on the risk and hopefully the reward of the company's future performance. Now, there's this really fascinating contrast here between the sheer thrill of early growth potential and the strict reality of high volatility. On the plus side, getting in on an IPO means you're getting early access. You're buying into innovative, sometimes disruptive business models before the wider market has fully priced in decades of growth. It's honestly a great way to diversify your portfolio with some fresh equity. But flip to the other side, and the risks are absolutely substantial. We're often talking about unproven business models with very limited historical operating data. The market's reception is highly uncertain, which makes these investments incredibly speculative. You really have to balance the excitement of the new with the reality of the unknown. Moving right along to Section 2, how companies go public. So how does a company actually pull this off? The process builds from private preparation and strict regulatory checks to the ultimate public market debut. First up, the company prepares its financials and hires investment banks. These are the underwriters to manage the whole offering. Next, they have to file some pretty extensive paperwork with regulatory authorities like SEBI in India, for example, to ensure they're complying with investor protection laws. Once they get the green light, the company's management goes on a roadshow. They literally go out and pitch the stock to big institutional investors, which helps the underwriters figure out the final price band. Finally, shares are allocated to various investor categories, including retail investors like us, and the stock makes its official debut on the exchange where open trading actually begins. Which brings us to Section 3, applying for an IPO. Now that we know how companies prepare, how do you actually get your hands on these shares? Well, you can't just hand over a stack of cash. To apply as a retail investor, you absolutely must have these core prerequisites in place. First, you need a Demat account. Think of this as an electronic vault where your digital share certificates will be securely deposited and held. You also need a trading account linked right to it. Finally, and this is probably the most important part for the application itself, you need a bank account using ASBA, that stands for Application Supported by Blocked Amount, or a linked UPI mandate. What this does is securely block the application funds right in your bank account. The money isn't actually deducted unless you're successfully allotted the shares. It's a really fantastic system because it completely eliminates the hassle of waiting around for refunds if you don't end up getting the stock. Let's put some real numbers to this. This brilliantly illustrates what a real minimum investment looks like in practice. Let's take the recent Allotment Enterprises IPO as a textbook example. You see, in an IPO, you can't just buy one single share. You have to bid in what they call lots. For Allotment, the lot size was set at 19 shares. So if you were bidding at the upper price band of 788 rupees per share, your minimum required investment to even participate was exactly 14,972 rupees. And you see a very similar story with the Tempsonson Instruments IPO. Here, the lot size was structured entirely differently. Retail investors had to apply for a minimum lot of 50 shares at 300 rupees each. But look at the total, 15,000 rupees. It equates to a very similar financial commitment. Basically, regardless of the share price or the lot size, companies and underwriters purposefully structure these retail applications to hover right around this 14,000 to 15,000 rupee threshold. It ensures the IPO is accessible for everyday investors while still raising capital efficiently for the company. All right, Section 4, evaluating the hype. With your application ready to go, you really need to filter out the noise and figure out if a company is actually worth buying. Now, the gray market premium, or GMP, is a term you're going to see plastered all over financial media. It's essentially what buyers in informal, unregulated markets are willing to pay over the IPO price before the stock actually lists. It gets hyped up a lot by traders as this guaranteed sign of how the stock will perform. But listen, it is vital to remember that GMP is strictly an unofficial sentiment gauge. It's just a snapshot of the current market mood, definitely not a promise of listing gains. So whatever you do, do not base your entire investment thesis on a high GMP. Instead of just following that hype or trusting the big institutional names backing the IPO, you need to roll up your sleeves and conduct your own due diligence using the company's official prospectus. You really want to look at their segmental margins to see if their core business is actually profitable. Compare their operating cash flow against their profit after tax. Like, are they actually generating real cash or just showing clever accounting profits? Look closely at the promoter's track record. Examine the post-offer share float and the lock-in periods. Just to understand how much supply is going to hit the market later on. And finally, always look at their valuation. Things like their price-to-earnings ratio, relative to similar companies that are already listed. Honestly, this is where the real due diligence happens. That brings us to our final part, Section 5, Day 1 versus Waiting. The allure of jumping in on day one is totally obvious. Historical data shows average first-day price pops of 15 to 20%. This is actually a deliberate strategy by underwriters. It's called underpricing, and it's designed to generate excitement. However, the harsh reality for us is that most of those initial gains accrue almost exclusively to the institutional investors who were lucky enough to be allotted shares directly at the IPO offering price. For a retail investor trained to buy on the open market right after trading begins, well, that 15 to 20% pop has likely already been priced in. You're essentially buying at the absolute peak of the hype, right when the stock is at its most volatile. But let's look at the post-IPO timeline. When we lay it out like this, you can see exactly why having a little patience often serves long-term investors significantly better. In those first few weeks, a stock is just trying to find its true market value. At day 25, the underwriter's quiet period ends, which means new research and analysis finally hits the market, giving us much more transparency. Then, between day 90 and 180, those insider lockup periods expire. This is huge. Early investors and insiders are suddenly allowed to sell their shares, which floods the market with new supply and frequently drives the stock price down, potentially creating a much better buying opportunity for you. By 6 to 12 months, the initial hype has completely faded, institutional ownership has stabilized, and you can start to see real, established trading patterns based on actual earnings reports. Armed with a clear understanding of the regulatory mechanics, the actual truth about market data, and a solid, real-world strategy for evaluating underlying fundamentals, instead of just chasing gray market hype, you are now firmly in the driver's seat. You know exactly what it takes to get in on the ground floor, but you also know the incredibly powerful advantages of exercising a little patience. So, as you look at the next big company preparing to ring the opening bell, the choice for your next IPO investment is entirely in your hands. Will you buy on day one or wait for the dust to settle?